Hello and welcome back to The Note. It's been what you might call a blissfully peaceful day on the markets by recent standards. The S&P has had a good day and is now back in positive territory for the year. European markets have also had a strong day thanks to the latest news from Greece. The leaked details on what the Greek position will be in the forthcoming negotiations is deemed to be positive for the chance of a peaceful resolution there. I'd like to focus on one particular area though where we have seen a profound change in the last few days, and that is on the expectations from the Federal Reserve. Now there is one very clear way of showing what the market expects for the Fed funds rate, and it's from Fed funds futures, a measure that we've really not bothered looking at all for many years while the Fed funds rate has stayed stuck between 0 and 0.25%. Here is what the market is expecting for the Fed funds rate as of November of this year. For those who've forgotten, you take 100 and subtract the number, so when you are at 99.75, that shows that the market is pricing in a Fed funds rate of 0.25%. When you get to 99.5, that means we are at last pricing in an interest rate of 0.5% by November of this year. That point, as of now, has at last been reached, that the market on balance is braced for at least one rate hike from the Fed either this summer or this autumn. You can see there have been some big switchbacks recently. The main reason people are now convinced that the Fed will move was the strength of the latest labour market data. More broadly, those who argue against will say that the Fed wants a legacy of not having made any kind of mistake like was made in 1937 when the Fed tightened too early and brought in a second dose of the Depression. They want to be totally sure that the economy has recovered before they take the risk of rising rates. That is one argument. The argument against is that, particularly with the political environment at the moment, where there is discussion of auditing the Fed, of moving to the kind of approach which a very young Alan Greenspan was talking about, where you could do without the Fed altogether and replace it with a computer. While you have extra strong political pressures, the Fed does not want to leave rates on the floor any longer than it has to. It wants to show that it can start to exit from extreme monetary policy. At the moment, it's that latter interpretation that has taken hold. The market is now braced for higher rates later this year. Let's see whether that expectation remains in place, but it is, as you can see, a change from almost 5 years of confidence that we would still be stuck somewhere between 0 and 0.25%.